Welcome to this presentation on floating rates bonds, valuation and duration management with interest rate swap. The following areas will be covered in this presentation. What is a floating rate bond oblique notes? Characteristics of floating rate bonds. Valuation methods of floating rate notes. Duration of floating rate notes. Factors affecting valuation of FRNs, benefits and drawbacks of investing in FRNs. What is an interest rate swap? Characteristics of interest rate swap. Valuation methods of interest rate swap. Calculating net value of an interest rate swap. Duration management. Benefits and drawbacks of duration management with IRS. I am Aninda Datta, the presenter. Now, what is a floating rate note? A floating rate note is a kind of a debt instrument or bond that has a variable interest rate. The variable rate is linked to a benchmark index like LIBOR or SOFR. The interest payable on FRN is calculated periodically based on a benchmark rate plus a margin spread. The interest rate is reset at preset time intervals of say 3 to 6 months. The margin spread depends on the credit rating of the issuer and the market credit spread for the borrowers of similar rating. Lower the rating, higher is the margin spread. As interest rate payable varies with the market interest rate, so interest rate sensitivity and the duration of these FRNs are near zero. These bonds are generally issued for 3 to 5 years. These bonds are issued by governments, corporations, and financial institutions. These bonds are purchased by investors seeking protection against rising interest rate. These bonds are generally traded over the counter. If the benchmark interest index has a stiff upward slope at time of issue, the margin spread needs to be increased to compensate the investors, as investors receive the nearest yield only. Now let's see how interest rate payable on FRNs is calculated. The interest rate payable for each period is driven by forward rate for that period implied by the spot rates from the benchmark index. The forward rates are not visible but implied by the spot rates from the LIBOR curve. The margin spread is added to the forward rate curve. The floating rate bond with interest at LIBOR plus 3% with 5% maturity is given below in this table. Now let's see how payable interest for each period is arrived at from the spot rate curve of LIBOR. Now at the inception, these are the spot rate arrived from the LIBOR curve, and these are the forward rates. These are the forward rates calculated from the spot rate curves, and these are the margin, 3% margin added to the forward rates. And so this column gives the interest rate payable for each period. That is 6% for the year 1, 6.5% for year 2, 7.7% for year 3, like this. All these interest payables are arrived at the inception of the contract. Now these rates are reset on the next reset date as per the new LIBOR curve prevailing on that day. Now in the beginning, interest rate for the first interest payment is frozen. At time t0, the forward rates on the subsequent interest rate payment dates are not known. So forward rates are derived from LIBOR curve added to the margin spread are considered as interest rates. The next interest payment is frozen on the next interest reset date as per the new LIBOR curve. The forward rate is calculated as per this formula given. The market price of these bonds depends on the market perception of the credit risk involved. If the perceived credit risk is high, the discount factor used by the market to discount the future cash inflow is higher than the forward rates plus margin. The bonds are quoted at discount to face value in such scenario. If the market credit spreads for bonds of similar credit ratings are higher than the margin spread, the bonds are usually priced at discount to face value. If the market credit spreads for similar rated bonds are lower than the margin spreads, the bonds market price is usually at premium to the face value. The duration of a floating rate bonds is near zero but not equal to zero. Now this diagram shows the movement of duration of a FRN during the lifetime of the bond, especially during the time span between the interest reset dates. On an interest reset date, the interest rates payable are set as per the market interest rates prevailing on that day, reflected by the benchmark index, say LIBOR or SOFR. So the duration is near zero on interest reset dates, as evident from the diagram. As time progresses towards the next interest reset date, the market interest rate reflected by the benchmark index would be changing. As the discount rate used to discount coupons will be as per the market rates, those will be different from the coupons frozen on the last reset date. So some duration would come into the picture. Thus, duration would continuously increase till the next reset date, when again the coupons would be set as per the market rate. Thus, duration becomes zero. The duration calculation would be done considering all interest are to be paid on the next interest reset date, as the coupons are different from the market rates only till the next reset date. Therefore, the peak duration would be way lower than that of a similar fixed coupon bond. As floating rate debt instrument has minimal duration, so holder of a fixed rate bond could lower duration by moving to variable interest rate through an instrument called interest rate swap. Now, what exactly is an interest rate swap? An interest rate swap is a financial derivative where two parties agree to exchange interest rate payments on a notional amount over a specific period of time. An interest rate swap has the following characteristics: a fixed leg, variable leg, notional principal, swap maturity, and payment date. Now let's elaborate on these key concepts. The fixed leg, one party agrees to pay fixed interest on a notional amount. The other party pays a variable rate on a notional amount, usually linked to a reference rate like LIBOR or SOFR. The notional principal, the amount on which interest payments are calculated. However, this amount is never exchanged. A swap maturity. Duration of the swap is usually from 3 to 5 years. Payment dates. The dates on which payments are exchanged. Discount rate. The interest rate used to discount futures cash flows to present value. Now, what are the steps involved in valuing the interest rate swap? Valuing the fixed leg. Determine the fixed leg. The fixed leg is set at inception of the swap and remains constant throughout the swap period. Calculate the fixed payment. Fixed payment equal to notional amount into fixed rate into payment frequency. Discount the fixed payments. Each payment must be discounted to present value using discount factor from the zero coupon bond yield curve. The present value of fixed leg equal to summation of fixed payments divided by 1 plus RT to the power T, or RT is taken from the yield curve. Valuing the variable leg. Floating rate typically depends on market reference such as LIBOR or SOFR and resets periodically, reflecting the prevailing market interest rate. A floating payment equal to notional amount into floating rate into payment frequency. The floating rate of next interest payment only is frozen at the reset date. All other floating rates are only expected rates bound to change with change in market interest rates. So the discount factors are those expected rates. A present value of variable leg equal to summation of variable payments, all variable payments divided by 1 plus RT to the power T. Does net swap value equal to present value of floating leg minus present value of fixed leg? Thus net swap value could be determined by simple linear mathematics. The fixed rate is determined to a value such that the net swap value is always 0 at inception of the contract. Now, what are the uses and benefits of interest rate swaps? The benefits could be classified under 3 buckets: hedge, speculation, and locking. Interest rate hedge. An investor holding fixed rate bonds could hedge via IRS, that is, he pays fixed and receives variable. Speculation on interest rate movement. A speculator expecting rise in interest rate will pay fixed and receive variable. Speculation on interest rate movement. A speculator expecting fall in interest rate will pay variable and receive fixed in IRS contract. Borrowing cost locking. A borrower holding short-term loan could lock the interest cost by paying fixed and receiving variable. Borrowing cost locking. A borrower of long-term loan too could lock in interest rate by rolling over the short-term IRS contracts. The interest rate swap is a method of duration management and hedging interest rate risk without taking position in the underlying asset. There are many different hedging methods, but those require much more capital, as position in the underlying asset or in interest option product has to be taken. So holder of fixed interest bonds portfolio could reduce sensitivity of the fixed interest bond portfolio to changes in the market interest rate at low capital outlay by interest rate swap agreement. Including FRNs in a bond portfolio having long duration helps in reducing the duration of the portfolio. But duration management by this method involves buying assets, so is more capital intensive. However, the investor earns the interest on FRN, whereas the net present value of a swap is 0 at inception. So investor does not earn any assured income on margin amount paid in entering IRS contract. Thus, the choice of IRS or FRN in managing the interest rate sensitivity depends on the objectives of the bond portfolio and the funds availability for hedging purpose. This concludes this presentation. Various other aspects of bond valuation would be covered in the subsequent episodes.